Let me tell you a story about two neighbors that will completely change how you think about retirement planning. Meet Tay and Monica. Both just retired from successful careers, and both have worked diligently for decades to build identical $1 million investment portfolios. They live next door to each other, they use the same retirement planning strategy, and they're both planning to withdraw $40,000 annually from their portfolios using the famous 4% rule. There's just one difference. Tay retires in January of 2000, right before the dot-com crash devastates the market. Monica retires in March of 2009, just as the market begins its recovery from the financial crisis. Fast forward 15 years, Tay's portfolio nearly depleted, forcing him to drastically cut his lifestyle and return to part-time work. Monica's portfolio? It's grown to over $1.8 million, and she's living comfortably with money to spare. Same investment strategy, same discipline, same withdrawal rate. Dramatically different outcomes. How is this possible? The answer lies in something called the sequence of return risk, and it's why your first 5 years of retirement matter, in a way, more than the previous 30 years of saving. So if you're nearing retirement, or approaching a stage in your life when you're considering withdrawing from your portfolio, whether that's for early retirement, a career break, or transitioning to part-time work, make sure to pay attention to this video because it could mean the difference between financial security and financial disaster. But first, let's start with the basics. What is sequence of return risk? I know, on surface, this term, sequence of return risk, can sound complicated, but it's actually quite simple. When we read any statistics about returns on our investments, we automatically think average returns, that the market has had an average annual return of 10%. Now, when we're in the accumulation phase and we have a long time horizon, it is totally fine to think only in average returns. However, when we're getting ready to withdraw our money from our investments, we have to go beyond just the average returns. We have to start thinking of the order of those returns. Thus the term sequence of returns and the risk that comes with different sequence of returns. Let me share a simple example to illustrate this. Imagine two investors, each with $100,000 portfolios, both planning to withdraw $5,000 annually. And both portfolios will have identical average returns over 10 years. Let's say 7% annually. However, portfolio A experiences bad returns early. Negative 20%, negative 10%, plus 5%, plus 10%, plus 15%, plus 20%, plus 25%, plus 15%, plus 10%, plus 8%. On the other hand, portfolio B experiences good returns early. Plus 25%, plus 20%, plus 15%, plus 10%, plus 8%, plus 5%, negative 10%, negative 20%, plus 15%, plus 10%. Now, if neither investor withdrew any money, both portfolios end up exactly the same value after 10 years. They end up with the same value because while the order of returns were different, the average annual returns during that 10 years come out the same. But here's where it gets interesting. When both investors withdraw $5,000 annually, portfolio A, the one with the bad early returns, gets decimated. After 10 years, it's worth about $60,000. Portfolio B, with the same average returns but good early performance, is worth over $150,000. This is sequence of return risk in action. When markets crash early in your withdrawal phase, you're forced to sell more shares to maintain your withdrawal amount. This permanently reduces your portfolio's ability to recover even when markets eventually bounce back. Think about it this way. If you need $40,000 and your portfolio is worth $1 million, you sell 4% of your shares. If your portfolio drops to $700,000 and you still need that $40,000, you're now selling nearly 6% of your shares. Those extra shares you had to sell during the downturn, they're gone forever. They cannot participate in the eventual recovery. And this is not just a theoretical scenario. The famous Trinity Study from 1998 provides the research foundation that most retirement planning is built on. 3 professors from Trinity University wanted to determine safe withdrawal rates for retirement portfolios. So they tested different withdrawal percentages against historical market data over 30-year periods. Their key finding was that a 4% withdrawal rate succeeded 96% of the time when applied to a 50-50 stock-to-bond portfolio. This became the foundation of the widely used 4% rule. But here's the detail that often gets overlooked. That 4% failure rate wasn't randomly distributed. Almost all the failures occurred when poor returns happened in the first 5 to 10 years of retirement. The portfolios that survived those critical early years went on to thrive for decades. Subsequent research by Wade Pfau, professor of retirement income at the American College for Financial Services, and other experts has confirmed this pattern. Sequence risk is the primary threat to retirement success, not average returns, not inflation, not even market crashes in general. It is the timing of those crashes relative to when you start withdrawing money. In fact, Faust's research shows that if you can avoid significant losses in your first decade of retirement, your chances of success increases dramatically, even if you experience major market downturns later in retirement. Alright, enough with the research. Let's go back to the earlier example of how this played out in the real world with two actual retirement scenarios. Remember our two retirees, Tay and Monica? Let's dig a bit further into their numbers. If you recall, Tay, our first retiree, retires with $1 million in portfolio, a nice amount. And because Tay has read some articles about investing, he decides to follow the conventional retirement wisdom. Diversify his portfolio and withdraw 4% of his portfolio per year. $40,000 in his first year and adjust for inflation each subsequent year. But what is interesting about his story is not the amount he has and how much he is withdrawing. It is when he is retiring. Tay retired in January 2000, right at the peak of the dot-com bubble. And if you're a student of market history, you know what happened next was brutal. The market crashed 49% from peak to bottom by 2002. Tay's portfolio, despite being diversified, was devastated. But he still needed to withdraw money to live on, so he kept withdrawing $40,000. Despite the fact that by 2003, $40,000 inflation-adjusted withdrawal represented over 6% of his remaining portfolio value. Thus, even when the market recovered in the mid-2000s, Tay's portfolio could not fully participate because he had sold so many shares during the downturn. Then came 2008, delivering another crushing blow to his already weakened portfolio. By 2015, despite markets reaching new all-time highs, Tay's portfolio was nearly depleted. He was forced to dramatically cut his lifestyle and return to part-time work at the age of 80. Now let's look at our second retiree, Monica. Monica also retires with $1 million in portfolio, but unlike Tay, Monica retires in March of 2009, right at the market bottom after the financial crisis. And she follows the identical retirement strategy. Diversified portfolio, 4% withdrawal rule. Now, how do you think her portfolio performed? Very different from Tay's because of when she decided to retire. Unlike the time that Tay decided to retire, the market in this case immediately began recovering. Thus, Monica's $40,000 withdrawal represented exactly 4% of her portfolio value. And as the market surged over the following years, her portfolio grew even when she was taking withdrawals. When the markets experienced volatility in 2015, 2018, and 2020, Monica's portfolio was robust enough to weather these storms. Today, despite withdrawing over $600,000 for living expenses over 15 years, her portfolio is worth approximately $1.8 million. Do you see what happened here? Same strategy, same discipline. The only difference was the sequence of return they experienced in their critical early retirement years. This is why if you're nearing retirement or considering withdrawal from your portfolio, understanding why these early years matter so much is crucial to your financial survival. First, there's the mathematical reality of losses. A 20% portfolio loss requires a 25% gain just to break even. But when you're withdrawing money, the math becomes even more punishing. You're selling shares at depressed prices, which means those shares cannot participate in the eventual recovery. Second, there's a compound effect. Early losses combined with ongoing withdrawals create a permanently smaller portfolio base. Even if the market recovers completely, your portfolio cannot because you reduce the number of shares that you own. Think of it like this. Imagine your portfolio is a fruit tree. If you're just letting it grow, it doesn't matter if it had a bad year early on. It will eventually recover and produce the same amount of fruit. But if you're harvesting fruit every year and you have to take extra fruit during a year when the tree is struggling, you're weakening the tree's ability to produce fruit in future years. Third, there's a psychological impact. Watching your portfolio decline while you're withdrawing money can lead to panic decisions, selling everything and moving to cash. These emotional responses can turn a temporary sequence risk problem into a permanent financial disaster. The portfolio that survives those critical early years intact benefits from the compound growth on a larger base for decades. That's why Monica's portfolio wasn't just preserved. It grew significantly despite 15 years of withdrawals. Alright, so if this is a real risk that we have to be aware of, is there something we can do about it? It's not like any one of us have a crystal ball and we're able to know exactly where in the market cycle that we're at. And if you watch enough of my other videos, you always know there's something you can do. You don't need to just let sequence of return risk just happen to you. You can implement strategies to protect against it and dramatically improve your chances of finding success in retirement. So let's talk about some of those strategies. Protection strategy number 1, the bond tent strategy. With this strategy, you're essentially adjusting your allocation to mitigate for the sequence of return risk. As you approach retirement, or the stage when you'll start withdrawing from your portfolio, gradually shift to a more conservative allocation. Then shift back to a more aggressive one once you're through the danger zone. Here's what this could look like. At age 55, you might have a 90% stock, 10% bond allocation. As you approach retirement at 65, you gradually shift to 60% stock, 40% bonds. Then after you successfully navigate your first 5 to 10 years of retirement, the crucial years, you can shift back to a more aggressive 70% stock, 30% bond allocation. This strategy does require a bit of work because you'll need to constantly monitor your asset allocation and adjust them before, during, and after retirement. However, it incorporates both protection and growth, both elements you need in order to mitigate sequence of return risk. Moving on. Protection strategy number 2, the cash cushion strategy. With this strategy, cash is your best friend. What you can do is keep 2 to 4 years of expenses in the form of liquid cash. Now you can park this money in a high yield savings account or a money market fund, but at the end of the day, the goal is not to earn returns. The purpose of this cash is to prevent a scenario where you need to sell stocks during a market downturn. And on average, the stock market has recovered to its pre-crash highs within about 2.5 to 4.5 years after a bear market. Here's how it can work. When the market is doing well, you withdraw from your stock portfolio as planned. When the markets crash, you live off your cash cushion and leave your stocks alone to recover. During good market years, you can replenish your cash reserves. Protection strategy number 3, the flexible withdrawal strategy. With this strategy, instead of rigidly withdrawing the same amount every year, regardless of the market conditions, you adjust your withdrawals based on portfolio performance. One popular approach is the guardrail strategy. Set your upper and lower bounds for your spending. If your portfolio performs well, you can increase your withdrawals slightly. If it performs poorly, you reduce them temporarily. For example, you might decide to cut your spending by 10% if your portfolio drops by more than 15% from its peak value. This reduction is usually temporary, and once the market recovers, you can return to your normal withdrawal rate. Some retirees use even more sophisticated approaches like the floor and ceiling method. Set a floor, minimum spending at 80% of your planned withdrawal, and a ceiling, maximum spending at 120%. When your portfolio performs well, you spend up to the ceiling. When it struggles, you cut back to the floor. The key is deciding these rules in advance when you're thinking clearly, not in the middle of a market crash when emotions are running high. Protection strategy number 4, the delayed retirement option. Now, this is probably the least popular of all strategies if you're banking on retiring soon. But if you want to avoid the worst case scenario, we want to know all strategies available to us. In essence, if you're flexible with your retirement timing, consider working 1 to 2 extra years if the markets are performing poorly as you approach your planned retirement date. Studies have shown that delaying retirement by even 1 year during a market downturn can improve your long-term success rate from 60% to over 90%. You're essentially trading 1 or 2 years of work for decades of financial security. And if you're already retired and experience poor early returns, consider returning to part-time work temporarily. This reduces the pressure in your portfolio during the critical early years. Now, all these talk about withdrawing less or going back to work can make you feel dejected. However, I don't want you to walk away from this video feeling that way. I actually want you to feel the opposite, empowered and confident. Because learning about sequence of return risk should demystify exactly what you're protecting against, which makes building the right safeguards so much clearer. Bottom line, recognize that knowledge is power. When you understand how sequence risk works, you can have a plan for different scenarios instead of just hoping everything works out. You can control your withdrawal strategy, your asset allocation, or your retirement timing, all which can turn sequence risk from an uncontrollable threat into a manageable risk. Now, if you're watching this and thinking, this all makes sense, but how do I actually implement this for my specific situation? Well, if so, you're asking exactly the right question. Because here's the thing, while these strategies work, everyone's situation is different. Your timeline, your portfolio size, your risk tolerance, your other income sources. They all matter when creating your personal sequence risk protection plan. That's exactly why I created the Financial Tortoise community. Inside our private community, I help people just like you navigate these exact decisions through all the resources that the community has to offer. And the best part? It is now open for waitlist signups. Let me tell you about a recent member. Let's call him David. David, who is preparing for retirement, came to our community concerned about sequence risk because the market had been quite volatile lately. During our coaching sessions, when we mapped out his financial picture, we discovered he actually had more flexibility than he realized. He could use a combination of cash cushion, timing of his withdrawals, and part-time work to drastically mitigate sequence risk. He was able to find confidence because he had a plan, no matter what the market threw at him. That is the power of being part of the Financial Tortoise community. You never have to navigate these critical decisions alone or wonder if you're making the right choices. Here's what you can expect to find inside the Financial Tortoise community. You have access to one-on-one coaching sessions with me where we can work together to build out your personalized financial plan. Step-by-step member-exclusive courses on everything from developing the right money mindset to designing your ideal investment portfolio to minimizing taxes. Access to monthly live Q&A calls where we dive deep into key topics and keep you accountable. A private forum connecting you with other like-minded professionals on the same wealth-building journey as you. Quality tools, templates, and resources that simplify your financial decision-making. And here's something that I'm really excited about. We've just launched the Financial Tortoise AI Assistant, a custom GPT created specifically for the Financial Tortoise community members. This custom GPT is not only trained on all my personal finance investment teachings. As a community member, you can access it any time, day or night, to get instant answers. However, to maintain the quality of support each member receives, I only open enrollment a few times a year. So join the waitlist today at financialtortoise.com/community and get priority access when doors open again. Many members have completely transformed their financial lives through this community, and with the right guidance and clear plan, you can too. You deserve it. I would love to see you inside. Alright, with that said, let's get back to the video. Alright, so we talked a lot about the sequence of return risk and why your first years of retirement matter so much. Let me wrap up this video by talking about some action steps, especially if you're nearing retirement or approaching a stage when you will be withdrawing from your portfolio. First, consider a bond 10 strategy. Determine your current allocation and plan how you can gradually shift to a more conservative position as you approach your withdrawal phase. Then back to a growth-oriented allocation once you're through the danger zone. Second, build your cash cushion. Start accumulating 2 to 4 years of expenses in cash. Yes, this money will earn lower returns, but it is insurance, not an investment. Third, plan your flexible withdrawal scenarios. Decide in advance how you'll adjust your spending if markets don't cooperate. Having this plan before you need it removes emotion from the decision-making process. Fourth, if you have not retired yet, build flexibility into your timeline. Consider how you might extend your working years by 1 to 2 years if the markets are poor as you approach retirement. The bottom line is this. Your retirement success is not determined by market returns or perfect timing. It is determined by smart preparation for sequence risk. All that is within your control. Thank you guys for watching. In the theme of retiring well, if you want to learn some retirement myths that are just not true, please check out my video here. Until next time, all the best.